The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts. Do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Good day to everyone. It's Chuck, it's Mike, it's Tucker with you. And
feels like a Friday.
You know, I thought Monday this week felt like Friday, to be honest.
Yeah, well.
I got home on Monday and I was like, man, what a week.
Yeah.
But here we are. It's Thursday, and we got some economic data. We got Nvidia earnings. We've got some IPOs to talk about. I mean, honestly, kind of a fun little day for... Look, on Monday, I teased that this was going to be kind of a crappy week where there's not much interest. I'm kind of interested in today's stories, actually. And maybe that's just Tucker doing a great job curating the stack.
Usually is.
Probably is. But in any case, we've got some stuff to talk about today.
It is pretty fun in a big part because it's kind of IPO mania right now.
Well, and it's not just like weird little IPOs. It's not like, well, here's this little biotech company out of Fiji that's hoping to discover if they can turn snakes into people.
Yeah,
like,
it's not a bunch of people pushing SPACs on companies that barely have existed. It's
big names. Look, it's
big stuff.
Guys, it's freaking Elon Musk. And then it's
sending 1 million people to Mars.
And then it's artificial intelligence. Like, if you can't get hyped up about that, then you are not hypeable. That is what I have to say about that. But let's kick things off talking about a company that needs no introduction, and that is Nvidia. They reported earnings after the bell yesterday, and as they have for the last 3 years, their earnings are absolutely fantastic. They beat their estimates both on top and bottom line. Their margins were basically in line, maybe a touch light. They came in at gross margins of 75% instead of 75.1%. They guided for Q2 that they are going to do $91 billion in sales. That is topping the average estimate of $87 billion. Some analysts had them doing $96 billion in Q2. And so on the back of this, the best thing that you can say about Nvidia stock is that, hey, it's up 0.25%, which means, great, they did what they needed to, and they're sitting here as a $5.5 trillion company because by the end of this year, their calendar year 2026 earnings are going to be somewhere in the ballpark of like $360 to $375 billion.
Here's the reality.
Their calendar year revenue.
It is now tremendously difficult for Nvidia to surprise anybody. You know, like they grew their sales 85%, but look, this is nearly $5.5 trillion company who supplies every major AI company out there with semiconductors, and so they can't surprise anybody.
No, and everyone's paying attention to AI right now, whereas the times when they were really surprising people in 23 and 24 were when we were still, having ChatGPT write haikus in the, form of, Chuck Norris speeches and stuff like that. Today, people are actually using AI to do interesting and meaningful and cool, useful things.
Yep. So what did they say that was of interest that's out there? They continue to focus on their lack of ability to do anything in China and say that they've pretty much given up ground to Huawei when it comes to chip sales there. They managed to turn this as a opportunity rather than a threat, but they spoke about broadening their customer base beyond the major players out there. Why did they need to talk about doing that? Well, because guess what? Alphabet and Amazon are already developing semiconductors to compete with Nvidia, and pretty much everybody else out there wants to. So they're talking about, hey, we need to broaden our customer base. So all interesting stuff, but ultimately, I keep coming back to, this is going to be the last company that surprises us when it comes to the AI trade is Nvidia, because we know what all of their customers are doing.
Right. Once Microsoft and Google and everyone, not Google so much, Google's using a lot of their own chips. Even Microsoft is designing, their own chips now. They had an announcement this morning, I think, about a deal with Anthropic on that side. I think the only question about Nvidia is a market share one right now. Does some of this additional competition eat into their market share? And the data so far is not really. And if it is, who cares? Because they're still able to make plenty of money.
Yeah.
Now, is that going to last forever? No.
Right, because, let's think about this for a moment. They just spoke about how they are broadening their customer base because they face competition from Amazon, Alphabet, eventually Microsoft, and other
Intel.
companies. Does this not read exactly like what we're used to when it comes to hardware, which is a very high... What did you just say their profit margins were in the most
75% gross, and let's see, we've got operating margins at 60%.
So you're a hardware business that's running operating margins of 60 to 75% on what is granted earth-shattering technology. So, yes, granted. But you're telling me that you're going to maintain that over the course of the next 5 years? I don't think so.
Here's what NVIDIA's trying to do. Here's the case against commoditization in their business. And Jensen's talked a lot about this in terms of when you look, and again, I know 1% as much as I need to in order to actually explain this fully, but I'm going to give it a go. When companies are designing their models now, it's not just about raw computing power, it's about the specific architecture for the chips that allow things to flow in the way that they are built and racked and put together and everything. Mm-hmm. And one of the things that Jensen's talked about is, hey, if you build a model and it's optimized to run on NVIDIA hardware, if you were to go and grab Trainium chips from... those Amazon, yes, or TPU chips from Google, it wouldn't run as efficiently because you've optimized for a certain hardware.
Okay.
You can still run it on them. It's not, but it's basically, okay, we've built things this way because this is how it needs to be run. The way that I'll, connect...
That sounds like IBM to me.
It is. Look, the x86 architecture that is still used today is something where, okay, when you're talking about IBM compatible PCs, it's the idea of, okay, this is how we did it. Now, again, it didn't end up, creating dominant market share for IBM because they licensed the technology so it could be used, elsewhere. But it is something where NVIDIA is saying, yeah, if you're used to constructing models for our architecture,
switching over is
you can't just switch, and so we can maintain some pricing power through doing so.
Okay.
Do I fully buy that? I buy some of it at least, but again, I'm not qualified enough to be able to tell you if, it's 100% certain or not. What I can tell you is that model commoditization is absolutely going to be happening, and that means that a lot of these companies are going to need to figure out, hey, how can we get our costs down in order to be profitable, because we can't keep spending what we're spending on this stuff. It doesn't make sense.
Now, what do you mean the businesses that are using the models, not the model? Well, I guess the model creators
too. Because eventually, if all the models are basically doing the same thing, and there are no switching costs between models, then you're looking at it and you're going, okay, that's going to drive model costs down. And if it does that, then the cost of all of the hardware inputs has to be driven down as well in order for these companies to be profitable.
So we have a few minutes to tackle this.
We've got 2 hours, actually.
Are the models more likely to go the direction of search? Where, I mean, realistically, while I use Google for everything, it is not so much better than Bing that if I were forced to switch, it would be detrimental. It's just that Google managed to dominate the market share. Or is it the likes of social media that the next best and greatest thing is going to constantly leapfrog the other one, and it's going to be fairly easy for the kids to switch? Or is it something, are those not the right comparisons, I guess?
What if... Here's another one as a possibility, because I don't know. Everyone's going to be trying to figure out what can keep people in our ecosystem, because as commoditization happens, that's what companies do. They say, what can we use to differentiate ourselves? But the other one that I'll put out there as a possibility is, look, what if the models end up being like a web browser? Like, you don't really pay for the web browser right now. Mm-hmm. You don't really care, but everyone has one that they're just kind of familiar with, but ultimately it's not a thing. It's just kind of the chassis for the whole thing. It's not where the actual stuff. Yeah. So I don't know. I really struggle with it, because what you are seeing is, again, everyone's releasing new models weekly or bi-weekly now. Mm-hmm. That's a sign of commoditization,
right?
And they're all benchmarking pretty similarly. There's not that much differentiation there. So I don't know exactly how to reconcile it all, but what I will tell you is this: artificial intelligence is not going to be the one business that never sees its margins go down as more companies enter. I'm willing to say that.
Yeah.
Let's take a quick break. When we come back, we're talking about some upcoming IPOs. SpaceX, Anthropic, OpenAI. Get excited next.
Stay informed and prepared for market changes and breaking business news. The Financial Exchange is live every day on YouTube. Tune in, subscribe. From breaking news to market analysis, follow the Financial Exchange Show on X and watch the show live every day. This is the Financial Exchange Radio Network.
The Financial Exchange is proud to be a partner of the DAV Department of Massachusetts. Nearly 400 runners have already registered for this year's DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston.
All right, so we are heading towards basically the biggest IPO boom in history when we talk about the scale of the individual companies that are going to be IPOing this year.
I think we should maybe put together a custom sound intro for IPO Mania 2026, Tucker. Something exciting.
Okay. I'll look into it.
Yeah, I know you built that cool background noise for Wall Street Watch, and I'm thinking an IPO Mania 2026 bumper.
Can you just? I bet you could do this using AI now. Can you just get a big crowd chanting IPO, something like that? And
he's gonna make it cooler. Let's let him do it. Generally speaking, whenever I have an idea,
I got nothing on my plate.
It's for something audio. I think that it's going to be cool, and then Tucker comes up with something way cooler, like when Paul LaMonica disappeared on us for 6 months and then came back. It was way cooler than anything I thought of.
What happened then?
Return of LaMonica.
Return of LaMonica.
For Return of the
Mac. That was good, yeah. I did enjoy that.
Yeah.
So, let's talk a little bit. We've got 3 big IPOs that are coming down the pipe right here. We'll go in order of their anticipated IPO-ness.
Meaning the date?
Yes.
Timeline?
Yes.
Chronological order?
First up is SpaceX, who the S1 for SpaceX just became public yesterday. And
what's an S1?
It's the
not
filing.
Exactly common.
It's the filing that they need to make with the SEC in order to basically say, here are the financials for the company, here are the risks present, and give investors the ability to make informed decisions about what to do. So I think it's instructive to walk through the numbers first and then some of the commentary inside that S1. This is going to take us a little bit of time to go through. Here's what we know. Revenue for SpaceX, and this is calendar year data. Or maybe it's fiscal, whatever it is. Either way, it's full year data. 2024, about $14 billion in revenue. 2025, about $18.6 billion in revenue. If one were to do some math on this, what you would find is that you are seeing about a 33% growth rate in revenue for SpaceX.
Okay.
Their actual space revenue declined slightly year over year. Okay, that's not like great. If you're a company called SpaceX and your space-related revenue is not going up, like, okay, it is what it is. Expenses increased from $13 billion in 2024 to $21 billion last year. On top of that, you had some interest expense from outstanding debt and stuff like that. Long story short, last year, company lost about $5 billion.
Okay.
They're targeting a $2 trillion valuation, which is 107 times sales.
So just can you repeat that revenue number for me?
$18.6 billion.
Okay, so just to give you a sense for some big boys out there in terms of, I just was looking at the biggest companies by revenue, so not market capitalization, but how much revenue do you bring in? Walmart's bringing in like $680 billion in revenue. Amazon, close to that. United Healthcare, $400 billion. Apple, nearly $400 billion in revenue. SpaceX is going to be bigger than a lot of these guys on $18 billion in revenue and a giant loss.
Yes.
Okay.
And a widening loss also.
Okay.
So it's one where, again, they're gonna if they get a $2 trillion valuation, you're talking 107 times revenue. Now, it's one thing if your revenue is doubling each year. It's another if your revenue is going up 30%, and you kind of look at it and you're like, okay, so what does this mean? Let's say their revenue growth stays similar. Okay. If you look at this 5 years out, they've got $77 billion in revenue then.
Okay.
5 more years, $322 billion in revenue.
Okay.
So even if
you're approaching an ExxonMobil by then.
10 years from now, if they grow at this rate, they are still going to be 7 times sales at $2 trillion.
Yeah. Now, Elon Musk would tell you that space is the final frontier, Chuck, and the revenue opportunities are limitless from things like mining in space and colonizing Mars. So obviously you're wrong there, but
I understand. In fact, so here's the thing. In a lot of these S1s, you generally see like pretty conservative language because
you don't want to mislead investors into getting sued right after your IPO.
Quite honestly, like the SEC doesn't generally allow a whole lot of fluff in these things. Like they generally, want you to be kind of controlled on this. For future markets, they talk about space tourism, in-orbit manufacturing, passenger and cargo transport to the moon and Mars, energy production on the moon and Mars, asteroid mining. Guys, like, I gotta be honest, if you're investing in SpaceX because they're gonna mine asteroids, you can wait until they start mining the asteroids.
Might be a little bit earlier.
So, again, none of this is to say how the company will or will not perform. If they get a $2 trillion market cap, I could see a world in which it becomes an $8 to $10 trillion market cap 10 years from now. Like, none of this is, like, crazy to think of because markets are not necessarily rational in this and that. But what I am saying is the actual financials of the company have some, question marks as far as, hey, do they support that valuation if Elon Musk were to no longer be the CEO? And I don't think that you can answer those questions conclusively. Let's take a quick break. When we come back, we got Wall Street Watch and more IPOs.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Nvidia earnings are here and markets are mixed with a modest sell-off in tech. Right now, the Dow is down only 4 points, completely flat. S&P 500 down over 0.4%. NASDAQ down 0.7% or 188 points. Russell 2000 is up nearly 0.2%. 10-year Treasury yield up 3 basis points at 4.60%. And oil up nearly 3% higher, trading right around $101 a barrel. Nvidia posted record sales and income in the first quarter, driven by demand for data center computing and the rise of AI agents. The chip giant also announced an $80 billion share buyback plan and increased its quarterly cash dividend from 1 penny to 25 cents a share. The stock down by 2% so far. Meanwhile, several quantum computing stocks seeing gains after the Wall Street Journal reported the Trump administration is awarding $2 billion in grants to 9 quantum computing companies in deals that include U.S. government equity stakes. IBM is the biggest beneficiary of the package, with the Commerce Department agreeing to give the company $1 billion. IBM stock is up by 7%. Elsewhere, Walmart said sales grew in the first quarter as shoppers looked for value and bought more online. However, the retail giant issued a worse-than-expected financial outlook amid surging gas prices. Walmart down by 7%. And TurboTax parent Intuit announced plans to lay off 17% of its workforce as it remakes itself into an AI-first platform. Intuit shares are plunging by 19%. I'm Tucker Silva, and that is Wall Street Watch.
So we talked about SpaceX. OpenAI is next on the list because it sounds like they could be making a filing for their IPO by tomorrow.
They might do an S1.
Yes, they might. And so it'll be very interesting to see what we get from them. The timing then, probably running maybe a month or so behind SpaceX, somewhere in the mid-summer range. Kind of a quite honestly, a strange time of year to IPO, just because if there's one thing that I know about investment bankers, they generally prefer to be in the Hamptons in July and not in New York City.
Too bad.
But
this year's going to be the exception.
When you got to feed the ducks, you got to feed the ducks. I don't really have anything else to say about the OpenAI one, just because we don't have anything reported right now on it, so we'll see what we get tomorrow. But it does sound like they're trying to speed their timeline up as well. Finally, the third one in the group, this was kind of wild. So Wall Street Journal exclusive yesterday around 5 p.m. Anthropic looks like they're heading towards a fall IPO. Again, we'll see what we get from OpenAI, just because I'm curious to see their numbers. The growth that Anthropic is going through right now is actually the most insane that I've ever seen in any company. To put this in perspective, they are expecting their revenue to come in at around $10.9 billion for Q2, which is a $44 billion annual run rate. Mm-hmm. Again, this is just kind of nuts. If you look at where they have come from, they've grown from a $9 billion annual run rate at the end of last year, so December 31st, to $44 billion in a 5-month span. To put this in perspective, y'all ever heard of Meta?
Facebook?
Yeah. The Zuck. Do you know how long it took them to go from $9 billion to $44 billion in revenue?
8 years.
4 years. Yeah. Anthropic just did it in 5 months.
Allegedly. I mean, yeah.
Mike, they're not going to lie about it before they IPO.
No.
I mean,
it really, the timing of it, though, is fascinating, because this literally came out at the exact same time that OpenAI hinted that they're going to file their S1. And so, one, I wonder if OpenAI even files it. You know, if this is the news coming out of your direct main competition that you have.
Sure.
If you're not profitable, or if you don't have a very clear path to profitability in that S1, you probably don't file the thing, because you're going to get bludgeoned.
the other piece with Anthropic is, and again, we'll have to see the actual financial reporting because, again, this is all being reported by the Wall Street Journal. And look, again, they're not going to lie. I don't think this is all just some giant fraud, is what I'm telling you.
Sure.
They're also reportedly profitable at these levels of revenue.
I know.
Which is the more impressive piece, quite honestly. Now, it's not like a crazy level of profit, but they are expecting to turn about a $550 million profit in the quarter, which, if you do the math out, is like a 5% profit margin, which is pretty impressive given that last year they said that they didn't think they would be able to turn a full year profit until 2028. Now, they also didn't think that they would grow this quickly.
Sure.
But Claude Code and the associated products with it are, again, like they are the fastest growing part of the AI space, according to just about any data out there right now.
Do we have any estimates for OpenAI and Anthropic valuations?
Both that I've seen are somewhere in the $1 trillion range.
Okay, so just bear with me for a moment here. What was the name of the hardware company that went public a few weeks ago?
Last week.
Last week.
The chip company?
Yeah.
I found out it's actually pronounced Cerebras, not Cerebras.
Okay, so Cerebras goes public and immediately fetches a valuation of
$95 billion.
Okay, so nothing. We then have planned IPOs from a potentially combined $4 trillion. Now, there's not $4 trillion of equity just going out into public markets. That's not what's happening here.
Most of it's locked up for the first 180 to 365 days.
SpaceX, in fact, is releasing a minutely small portion of their total overall equity as part of this IPO. So small, in fact, that a bunch of it breaks the current rules of a bunch of indices that are rapidly putting in changes to be able to include SpaceX into their indices. But where does this money? I mean, I don't think that people are just sitting on a few $100 billion in bank accounts saying, "Oh, have I been waiting for these IPOs or what?" That's not the sense that I get right now.
No, the estimates that I have seen are that from a liquidity perspective, you're talking like a couple $100 billion to a few $100 billion need to come from somewhere. And as you know, like it's not just going to be people who are like, you know what? Call up Bank of America, tell them to wire $10 billion to, right. It has to generally come from other assets that are held in investment accounts. And so the question that you do have on these pieces here are, get away, you fly. What are you doing? There's a bug all over my microphone, and it was bothering me.
I don't even see it.
I know. But
Chuck turned into a schizo here.
The money has to come from other risk assets, and so potentially these IPOs can act as a liquidity drain on other parts of the market. Now, the counter to this is everyone who can do math is looking at these numbers saying the same thing. And generally, once you've identified a problem in markets, usually that doesn't become the main source of, the issue in financial markets, because everyone then works to address said problem. It's kind of like, think about any crisis that we go through in markets. Oh, like, hey, back during COVID, hey, like, we're shutting this down. Great, here's a bunch of money. Okay, there's the fly. See? It's right at your nose.
Yep, yeah,
it's right at your nose. It's a very aggressive fly.
We're going to have to break before I knock myself unconscious.
You ever see those rackets with you electrocute the fly? I got a couple of those at home. I got to get one here for the studio.
Yeah, my brothers and I.
How much voltage you got? How much voltage you got in that thing?
It's a good amount.
We would always dare each other to lick it.
What?
It's what brothers do.
This is my co-host.
Yep.
So, again, I don't know that this actually has the impact on markets that could be feared, because everyone knows this is coming. But at some point, the actual mechanics and flows may overwhelm that and be like, okay, this is going to cause something. So,
you know what we need, just purely for the entertainment factor, and it's never going to happen, but an OpenAI and Anthropic IPO same week. The investment banks wouldn't like it. The companies wouldn't like it. But I can imagine nothing more entertaining in markets than these two companies who there is no more direct competition. Maybe Google, but no other pure plays quite like them. To see them go public and even the same year is going to be fascinating.
I just keep thinking about how I'd like to see OpenAI merge with Shutterstock so they could be called Open and Shut.
Sure.
I think that'd be nice.
Yeah.
Let's take a quick break. When we return, let's dig in on this quantum computer story that Tucker talked about. We'll talk to you about what's going on and who the beneficiaries are of it after this.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long. Get real-time financial insight as news breaks. The Financial Exchange is live on X. Watch the show and follow us for the most up-to-date business news you need to know. This is the Financial Exchange.
All right, we got a piece here in the Wall Street Journal. U.S. to award quantum computing firms $2 billion in take equity stakes. And 9 firms are going to be receiving grants from the U.S. government. IBM's getting the biggest with about half of it at $1 billion. And 8 other companies are going to take home the remaining amount. And look, I've got kind of mixed feelings on this. On one hand, I am a big believer that, in general, the U.S. government can produce, through its investment, some of the greatest scientific breakthroughs that we've seen.
Sure. See GPS, laser technology, pretty much anything that has, come about over the last... Yeah.
I'm also generally a believer that the way in which that benefits the most people is through that development taking place through government labs and then being able to either sell or license the technology out, similar to, GPS and stuff like that, as opposed to saying, hey, here are the companies that we think should be the winners and or losers in that particular business.
Yeah, I'm just not sure that we, as society, want the U.S. government and thereby Congress and the president to be, I guess, the steward of shareholder value?
Deciding which companies are worthy of investment.
Well, keep in mind, too, we're not talking about just the initial purchase. The U.S. government then owns those shares.
Right. Like,
not necessarily, maybe in perpetuity, maybe not forever.
Do we want the state to own companies? Because here's there are a couple of principal dangers in this. The first is, hey, we've invested this much money, it's not going well, let's invest more and try to turn it around. Now you're taking capital from what could otherwise be productive resources and trying to, chase after money that might have gone bad.
Sure.
The other piece is, hey, let's say that I'm a genius.
Okay.
Like, not even a genius, let's say I'm a super genius.
A super genius. Oh boy. Okay.
Super genius.
Okay.
And I had a dream about how to solve quantum computing. And I decide, okay, I want to start this quantum computing company. Then all of a sudden the U.S. government comes in and gives IBM $1 billion. And I'm sitting there and I'm like, well, I can't compete with that.
Right.
Like, it squashes competition because you don't want to be competing against the U.S. government's interests there. Like, it's just not a situation where you can fundamentally win. They have unlimited coffers, and I do not.
Right.
And so these are the questions that you get into on these kinds of things. And it's not to say, hey, I don't want the U.S. government trying to encourage innovation in certain areas. But it is to say, when you start talking about taking equity stakes in publicly traded companies that, are not necessarily, like, IBM, let's be honest, maybe they end up solving quantum computing, maybe they don't. They've kind of been a joke for the last 15 years.
Yeah.
So it's kind of like, okay, why are they getting $1 billion here?
I mean, not a dissimilar argument from Intel.
When's the last time we talked about IBM?
Right.
I think the last time we did, it was one of the last couple earnings seasons where we were making fun of them for basically having gone nowhere for a while.
Like the counter argument would be you're in a direct competition with China, who very much embraces the public-private investment partnership.
So let's model ourselves after China?
Yeah, I think it's...
I'm a hard no.
Yeah, I'm with you. I don't think it's a compelling argument, but I think it is an argument that some would lay out. And I would look at that model and say, I can't say that it's been a defining success over there. So, I'm with you. I don't think it's a good idea. I think there's some roles that government can play, such as ensuring the technology on quantum computing and other critical technologies that are developed here stay here from an IP standpoint. And I just think there's better ways to do that than taking an equity stake in the companies themselves.
There are places where stuff like this can make sense. When we were talking about the stuff like, rare earth materials where, hey, the investment from the private sector doesn't make sense because the dollars just don't work.
But even there, you don't need an equity stake.
You don't.
You can just say, hey, the U.S. government is going to be a buyer of this product at this price if it's managed domestically, and you still don't need to go in there and own the company permanently.
It's true. It's a real question as to whether or not you want the U.S. government owning significant
It's like
stakes.
with anything else we talk about. When we talk about the expansion of government, you cannot just sit here and say, well, yeah, but I trust President Trump.
Right,
he's not going to sell it all and take the shares personally when he leaves office. That's not how this works.
Well, and the other piece is, okay, if you're, again, just play out the string, and I'm not saying anything. If you're okay with this because there's a certain president in the White House, but then a different one comes in, would you still feel the same way?
Yeah.
If you've got President Newsom in 2 years,
right?
Are you yep, I trust that deal making? If you've got, President AOC in 2 years, are you yep, I trust that deal making? You got to look at it from the broader perspective of overall governance and not, well, they can do this now because I trust them. And it's generally why I get to a place where I'm okay, picture the person who you think is least qualified in the role, and what powers would you want to grant them?
Right.
It's just a case of, in general, you don't want any one person to have the ability to make these kinds of decisions because eventually you're going to run into someone who makes bad ones. And this is why having those responsibilities and powers delegated to, consensus through things like Congress tend to make more sense, or we can just not take, public stakes in public companies. Yeah, or capital markets where you can allocate capital efficiently, and if the idea is not investable, then it gets destroyed. Let's take a quick break. When we come back, well, we got hour 2. Luke Kawa from Sherwood News is going to join us. We're talking Walmart, TSA, and a whole lot more.
Mike Armstrong, your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you here, and as we kick things off, stocks just for the last week or so kind of stuck in neutral, trying to figure out what comes next. Actually, more than the last 2 weeks, since about May 8th. So, again, a little bit more than 2 weeks that we've been here now, and just kind of treading water. We had that one spike up to 7,500 on the S&P, but other than that, we're kind of hanging out in the 7,400 range.
Sure. Oil prices fell yesterday below $100 a barrel. They're back up today above $100 a barrel. Iran's supreme leader saying that uranium must stay in the country, causing some of that. Then an Iranian unnamed official said, no, that's not true. So
As I've said since the beginning, I don't know what's going on negotiating-wise. Right. I'm not going to pretend to. All I know is what is or isn't happening in terms of production and transit, and there's just not much going on there. Stocks modestly off today. S&P down 36 points, about 0.5%. Nothing crazy, just a little bit of a garden variety pullback. Dow Jones is, down 118 points, about 0.25%. NASDAQ Composite down 195, about 0.75%. So a little bit of a sell-off taking place, but again, nothing too significant. Bonds selling off modestly as well. 10-year Treasury back up above 4.6 at 4.619%. We got the dollar up 0.31% to 99.32, and gold off 26.30 an ounce to 45.09. Crude oil, as Mike mentioned, back above $100 a barrel at 101.40 on West Texas Intermediate. Gas prices rising as well. AAA national average up 0.9 cents to 4.56 and 4/10. Diesel also holding near its recent highs at 5.65 and 6/10 as well. So that is what is moving in markets today. We got Walmart earnings before the bell. And here's my big takeaway. Walmart said that they expect their full-year sales to rise somewhere around 4 to 5% this year. That is pretty much in line with where inflation is heading. And so the takeaway that I have is Walmart is able to pass through prices to customers, but not really expecting to see much in the way of any kind of organic growth.
Yeah, look, they pretty much told everybody that, hey, in the first quarter, while the tax cuts that people, or tax refunds that people received were helpful and helped offset some of the impact of higher gas prices, now that money's spent, and as far as spending is going from our customers these days, it's being drawn down based on the price of gasoline, and pretty much that's it. And they cannot keep pace. They're obviously drawing a pretty big differentiation between their lower income customers and their higher income ones, and they're seeing that spending difference. But I think they are echoing something that many have been saying now, which is, yeah, if you are already cash strapped, suddenly seeing gas prices shoot up 40% is going to make it pretty tough for you.
Walmart stock off 7% on this news now. It's basically been just kind of a straight shot down over the course of the day. They didn't open in this range. They opened down about 2 or 3%, and then just kind of slid during the first half hour of trading and have been chopping around ever since. I think the overall story that we've gotten from retailers in this set of earnings reports is pretty consistent with what we've seen before, which makes sense because, again, Q1 earnings, 2/3 of that was before the war even started. And yes, like now we've seen higher gas prices, but they, even in Q2 there was a ramp up period through April to get to where we are. The story that we're hearing is, yep, people are still spending money. We're not really seeing any kind of positive inflection, but we're not seeing a huge negative inflection yet either. That could change, but to this point, we haven't seen it. And this is the part that I keep coming back to about the U.S. economy. Like, you've got to be able to hold two conflicting views in your head right now to understand what's going on.
Right.
Number one is gas prices and all kinds of prices are rising right now. Like, not just gas prices. You got stuff going up across the board. Like, take a look at what's going on with freight rates. I know, Tucker, when do we have Craig Fuller coming on? Is it next week now?
Friday, June 5th, so
2 weeks.
Couple weeks out.
So you've got like freight rates that are going absolutely bonkers right now. You obviously have gas prices that are moving up. You've got memory chip prices that are driving up electronics costs and things like that. So there's a lot of different price pressures that are there that are making people feel really uncomfortable. Despite that, there is so much demand for AI computing power right now that is just overwhelming any of those potential concerns and throwing a bunch more money into the economy and generating, the economic activity that unfortunately might end up supporting the inflation that we're seeing.
Yeah, we talk sometimes about this when it comes to government spending, right? When you talk about government spending, one of the big problems with it is that it can crowd out other spending, right? Like when the government increases all of its defense spending, you potentially, drive up prices because there's just competition now for those goods. Right now, what we have is AI spending crowding out just about everything else. It made up 80% of GDP in the most recent quarter. It's driving up prices in some key areas, and when accompanied by an oil price shock, it's kind of leading to shortages. Might not be the right. Well, yeah, it's leading to shortages at least in some products that go into the AI trade. So we are experiencing this still, and I don't know. I tend to always think that when everybody's worried about an inflation burst, it probably isn't likely to happen. But I'm not really convinced right now that people believe that an inflation burst is coming.
No one's worried about it.
Yeah.
People are worried about inflation that's here now, but I don't hear many people that are worried that it's still going to be here 6 to 12 months from now.
Right.
Let's take a quick break. When we return, Luke Kawa from Sherwood News joins us right after this.
Missed a show? You can find them on our YouTube page.
All right, time for trivia here on the Financial Exchange, and tonight is the final airing of The Late Show with Stephen Colbert. Colbert got his big break in Hollywood when he became a writer for a short-lived sketch comedy show starring a former SNL superstar. So our trivia question today: what was the name of the sketch comedy show Stephen Colbert wrote for in the mid-90s? Once again, what was the name of the sketch comedy show Stephen Colbert wrote for in the mid-90s? Be the seventh person to text us at 617-362-1385 with the correct answer, along with the keyword trivia, and win a Financial Exchange Show t-shirt. Once again, the seventh correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
All right, we're still getting Luke Kawa all queued up here, but in the interim, I want to talk about this piece from the New York Times that we didn't have a chance to get to earlier.
We got Luke.
Oh, we got Luke?
Yep, let's go to him.
Wonderful. Luke, how you doing today?
Doing great. How about yourself?
Fantastic. This is Luke Kawa with Sherwood News joining us. Luke, when we look at this market right now, we get a lot of people listening that have, some kind of different thoughts in terms of, hey, it's great that, AI is, doing all this stuff, but the real economy feels pretty bad because of high gas prices. How does one reconcile the discomfort with what one is feeling in their personal financial situation with what they're seeing in markets?
Oh gosh, extremely hard to do. That's almost beyond the ability of a market scribe to be able to help you out with.
Well, tell me about the market piece. Why are markets so good right now, I guess, for the last, month and a half?
I think markets are so good because of for the first time ever, I think we've had a lot of visibility into end user constraints for AI. I think that's been the most material thing that's changed over the past 2 or 3 months. And I think it's something that also started to come through just a little bit in Nvidia's results yesterday. If you look at it, it's about, from their data center segment, about half of it is hyperscalers and about half of it is other. Now, the fact that there is this pretty big other component, which Jensen Huang's arguing is more and more going to be, hey, your industrial company, your chip design company that needs a data center right by it in order to be able to be its most productive and do its best work. That is something that I think is the dream on, but the thing that's been more tangible in the near term has been everybody getting mad about running into their cloud limits until they were relaxed a couple of weeks ago. So I still think that's been kind of the biggest thing that has added to a lot of AI momentum. And what I think it's also done is actually made the appearance of the real economy even worse than it is. High gas prices, yeah, that's a very visible thing that everyday Americans are running into all of the time. However, I think one part about the AI boom that can't be overstated is, given how big Nvidia is, given how big chips are as an industry group, if those things are doing so well, it is sucking all of the oxygen out of any positive story that you could tell about pretty much any other part of the market.
I want to dig in on that a little bit more. Is this a case where there's just not enough capital to fill all of the niches that need to be filled right now? And is that potentially why we're seeing yields moving up a little bit as well? Is just like, hey, we've got all this government borrowing, now we've got private sector borrowing, we got all these IPOs. There's only so many dollars to go around, right?
Yeah, I think what's really interesting is that, at the early yield jump that you get on, the war in Iran, oil prices rising, that's one thing. However, the long end and longer term inflation expectations measures really started to take off after the ceasefire. So that's more of a case of folks going, hey, well, if the party in AI and issuance, if that's still going, then that's actually a much bigger risk to the long end and long-term yields. And I do think that's a reflection of just the idea that you have a lot of government spending. You also have a lot of hyperscaler issuance. I believe they've already well and truly lapped last year's issuance already. I can't name a country that Google has not issued a bond in over the past 2 weeks. So I think that's a pretty important component. And there are two ways. It's not just through the issuance way that I think AI is driving a higher nominal growth environment and a shift towards a more inflationary one. If you look at the producer price index, which posted a big jump in its latest reading, one of the outsized components there was all the computer equipment we're importing. The price of that is going bonkers.
In terms of digging in more on the AI side of things, we got information from Anthropic yesterday. I think it was in a Wall Street Journal piece that was published that showed they're estimating that they actually might be profitable in Q2. Does that give us any information about where the broader AI industry may be able to find its footing as far as going from, hey, just crazy growth that can't make money to real businesses?
Yeah, I think honestly, very important, very supportive sign. Pretty much everything supportive about AI has been at its genesis to me an Anthropic story for the past 3 months and counting. So I think just the idea that, hey, all of this money we've poured in is actually bearing fruit at some point, and like, hey, we've got to the point where we can't call these companies, startups anymore. They're behemoths. They're going to be probably well in excess of $1 trillion when they IPO, among the biggest companies in the world. But just the idea that, hey, this hasn't been the equivalent of building bridges to nowhere, of China's building ghost cities for the U.S. spending outlet, that this actually has something of a return. Again, though, the big question is going to be, the adjusted return is, we're of course kind of effectively stripping out CapEx as an expense for a while. So this is still kind of more on the operational side. So it doesn't give us a great kind of long-term picture about the ROI. And again, we're also living in a world where this is, everyone's experimenting with this. So because they feel like they have to, we'll see the actual stickiness across enterprises, across industries, and whether that's as strong now as it is as strong in 6 months, 9 months, 12 months as it is now.
When we look at the broader market, I know obviously the last month and a half has been driven by this, monumental surge in semiconductor stocks. What's your take on the overall health of kind of the broader market when you look beyond what we're seeing in semis?
Yeah, I think the underperformance of consumer discretionary, whether on an equal weight or on just the broad market cap index relative to staples, is something that historically has been a bit of a flashing alarm bell for the market. And again, but it's very hard to strip away that from just the overall rise in oil prices, which I think is acutely impacting consumer discretionary companies and their outlook. That's pretty much the place where you start to see stocks go down, then earnings estimates go down, and then we worry about whether they have successfully navigated a shock later. But yeah, real income growth, not great, probably not great for the outlook for consumer spending. And I do think, though, more and more, the idea I keep coming back to is, the stock market is the economy for me. Over any 6 month period, they're going to tend to trend in the same direction, and the economy is becoming more AI. So it stands to reason that you can have a stock market that kind of looks pretty unhealthy in terms of the lack of breadth, but still is delivering some pretty substantial results.
All right, very good, Luke. Appreciate you joining us today, and have a great rest of the week.
Thanks, kindly. My pleasure.
That is Luke Kawa from Sherwood News. Did we already do trivia?
Yeah, we did.
Sure did.
Thanks for listening, yeah.
What was the question?
He was busy that day.
No,
Busy.
I was getting something else ready.
Yeah.
I was baking or something. Let's see. No, we already kind of covered that. I want to talk a little bit about the Fed. This is going to be a really interesting upcoming Fed meeting.
No kidding.
No. But Michael. I need to go into a little bit more depth here. Okay. Because I think this actually, not just because of Warsh coming in. I think Warsh coming in is a red herring for why this is so interesting to me.
Sure.
Why this meeting is interesting, in my opinion, is that we are clearly seeing in markets right now a disconnect between what the Fed was pricing in the last time we got their summary of economic projections in March and what's actually happening now. So for 2026, the March SEP was pricing in core PCE at 2.7% year over year.
Okay.
That obviously is not going to happen right now unless the U.S. economy goes into recession. It's just not viable at this point. Core PCE is already up to 3.2 and is probably heading towards the high threes,
low fours. Yep.
So I think the question is going to be, do we get, we are going to get a SEP for the June meeting. What does it tell us in terms of where Fed members, not Warsh, because again, Warsh is one person. Like, he'll try to build consensus and this and that. But what does it tell us about where Fed members now see the risks and benefits for the second half of the year? What are they pricing in as they look at the picture right now? And I think the problem that Warsh is going to face is, either way, there are some problems here. In that if they try to cut into an inflationary environment, they're going to lose control of the yield curve. If they say we need to hike, hikes aren't priced in any meaningful number right now. Let's take a quick break. Let's dig in more on this when we return.
Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets in negative territory after Nvidia earnings were released yesterday. Right now, the Dow is down nearly 0.3%. S&P 500 down over 0.4%. NASDAQ down 0.6%. Russell 2000 is up modestly, only 0.1%. 10-year Treasury yield up 4 basis points at 4.61%, and oil jumping over 3% higher, trading at $101 a barrel. Nvidia posted record sales and income in the previous quarter, driven by demand for data center computing. The chip giant also announced an $80 billion share buyback plan and increased its quarterly cash dividend from 1 penny to 25 cents a share. That stock down by 2%. Meanwhile, several quantum computing stocks are seeing gains after the Wall Street Journal reported the Trump administration is awarding $2 billion in grants to 9 quantum computing companies in deals that include U.S. government equity stakes. IBM is the biggest beneficiary of the package, with the Commerce Department agreeing to give the company $1 billion. IBM stock is up by 7%. Elsewhere, Walmart said sales grew in the previous quarter as shoppers looked for value and bought more online. However, the retail giant issued a worse-than-expected outlook amid surging gas prices. Walmart shares are now down by over 7%. And Spotify now rallying 14% after the music streaming platform laid out updated guidance for 2030 at its first Investor Day since 2022, forecasting revenue at a compounded annual growth rate in the mid-teens and gross margins between 35 and 40%. I'm Tucker Silva, and that is Wall Street Watch. In the previous segment, we asked you the trivia question. What was the name of the sketch comedy show Stephen Colbert wrote for in the mid-90s? Well, that would be the Dana Carvey Show. I know that Steve Carell was on that show as well. And we did not have a winner today. Nobody knew. We had guesses of Second City and guesses of In Living Color. But no correct answers to our text line today. So sorry, no winner.
Tucker, what was the question?
Are you serious?
No. Anyways, so during the last segment, we were talking
models.
Nailed it. In any case, last segment we were talking about this upcoming Fed meeting, and
Sure.
I think it is one of the most important Fed meetings in years, and not because of Jay Powell no longer being the chair. I think Kevin Warsh coming into this one is largely a non-factor. Like, yes, it's an unknown, so I know that there's like that piece, but ultimately, remember, the chair does, a lot of the work to try to corral the Fed to what they are thinking. But when we look at where we stand right now, here's the inflation picture. You've got, for the most recent month of data that we have, which we haven't gotten, we get PCE next week, correct? Let me take a look. Yeah, PCE is coming out. April PCE we get on Thursday of next week. The projections that we have for that are that, let's see, do I have them? No, I don't have them yet, so I can't really get into it.
3.5% year over year is what I'm seeing. 0.7% month over month.
Do you have the core projection?
0.3.
What about the year over year?
3.2.
So you got core PCE, and core PCE is at 3.2 right now. So you're at 3.2 at this point. You're expected to stay there. And in the March SEP, which I'm looking at right now, they thought that core PCE would come in at 2.7% for this year. So there's basically no path for that to happen at that point, given the prints that we are going to have seen by next week. And what I mean by that is, if you look at January through April, January was 0.4 on core PCE. February was 0.4. March was 0.3. Let's say April comes in at 0.3 as well. So overall, you are now, for the first 4 months of the year, at 1.4% cumulative during that time. Which means you only have, in order to get to 2.7, you've only got another 1.3 over the next 7 months, which means you've got to average 0.18% on core PCE.
Seems tough to do.
Guys, let's be honest. What is the mechanism for inflation to drop over that period for the entire 7 months, given where we are now?
Right.
The only one that exists is recession. And got to tell you, the U.S. economy doesn't look like it's heading anywhere near recession. Did you happen to catch the jobless claims numbers this morning?
210, was it?
Yes, 209.
Okay.
That is not recessionary. Yeah. Did you catch the continuing jobless claims numbers?
Nope.
1.782 million. That is actually still below not just last year's numbers, but the 2024 numbers as well.
Yeah.
There is nothing showing up that is recessionary in the U.S. data right now.
A lot of people nervous about jobs, but not filing for unemployment.
I'm not saying that the your personal economy is good. What I'm saying is it's not recessionary.
Yeah.
There's a difference between saying I'm paying too much for gas and we're in a recession.
So then what makes this meeting so interesting to you?
What makes it interesting is the fact that the U.S. economy is, in fact, in nominal terms, accelerating. It's just that growth is being eaten up by inflation right now, which is why we feel bad.
And that's why I think this moment with Warsh being at the helm makes it all the much more interesting. Because you know what? We've had 8 years of Powell giving us his, view and his ability to summarize the view of other members of the Fed. It's the first time that anyone, really outside of the Fed or President Trump himself, is going to hear from this new incoming chair and his perspective on that moment that you're describing, which is pretty objectively an inflationary growth acceleration environment. And does he agree? Right? Does he agree with that perspective that, hey, we are entering this moment here, and does that conflict with his view on rates?
So, because the two things that I want to see in the June SEP, what do they think core PCE is going to be for this year now? If they come out and they say, yeah, we think it's going to be a little bit warmer, we think it's going to be like 2.9 to 3.1, they're going to lose credibility. And when you lose credibility as a central bank, you end up like Argentina, Brazil, Turkey, all the places that have, had real trouble because they say, no, we don't need to do anything. And then the long end of the yield curve goes nuts because bond investors say, okay, you're going to let inflation run hot? Fine, you can't pay me 4.5% for a 10-year bond. What if inflation runs 4.5%? You got to pay me 6%. So that's the risk if they come out and try to downplay it.
Right, folks. If
I wasn't quite done yet.
Fine.
I had one more thing. On the other side, if they say no, inflation's going to be warm, and then we end up with, okay, now we've got a hiking cycle. Now your bonds end up having to sell off because of that as well, because we're not pricing in a hiking cycle right now. We're just pricing in one rate hike at some point in the next couple of years. So the point that I will make on this, it's a really tough needle to try to thread to say we're going to be credible against inflation, but in a way that doesn't result in one of those two things, because this is a risky time, in my opinion, for bonds, particularly longer-term bonds.
Yeah.
So that's kind of where I am.
Fair enough.
Cool. Let's take a quick break. When we come back, let's do a little bit of stack roulette.
Subscribe now to our YouTube page, where you'll find daily interviews and full shows of the Financial Exchange. We'll get you in economic trends. This is the Financial Exchange Radio Network.
If you missed any of our shows from this week, you can find them on our YouTube page. We stream the show live every day, but also archive every hour and all of our most newsworthy interviews and discussions. So just go to YouTube, search for the Financial Exchange, and be sure to hit that subscribe button.
Mike, do you mind if I kick off stack roulette?
I would love that.
Ah, wonderful. Piece of the New York Times. To 2026 graduates facing a bleak job market, the 1991 grads have some advice. First of all, I take umbrage with the fact that this is a weak job market for new college grads. And look, I haven't been one in about 20 years or so, but I do know how to read statistics. And here's what I can tell you. In September and August of last year, the age 20 to 24 unemployment rate sat at 9.2%. Today it is at 7.6%, having declined by 1.5%. In March, it was down to 6.4, but obviously this is a volatile data series. But either way, it's pretty clear that the unemployment rate for age 20 to 24 has come down significantly in the last 6 months. The age 25 to 29 unemployment rate has gone from 5.9% in January down to 4.9% now. On top of that, when we go to Indeed and look at their job openings data, what we are seeing is that their job openings have increased by around 2.5% since last fall as well. So I do understand that this is a lower hiring rate environment right now, but I got to tell you, what I'm seeing from a lot of companies that are going through layoffs, they are, like, the thing that you are absolutely seeing it show up in the data now, they're laying off expensive people in their 40s, 50s, and 60s, and they are hiring cheap kids.
Yeah.
That's what the data's telling me.
I know 20-year-olds aren't kids, but yeah. Again, even going back to 91, like that, the piece here was, hey, let's go basically talk or revisit a piece that we did with the parents of the kids that are graduating right now. The unemployment rate back then was over 10%. At least there was an argument back in 91 that, hey, this is a tough job market. I'm trying to look at the prolonged periods of time where the unemployment rate for 20 to 24-year-olds was under 7%. I mean, it was the very late 2010s.
1999?
99.
Right, so
you have to go back to the 60s. The last time, like when college graduation rates were much lower, to find a time when it was prolonged below that 7% rate. So, look, I don't debate that AI is scary and that it is challenging right now sometimes to find the exact type of role you're looking for, but the data just don't back it up.
And every generation, as they're coming into the workforce, goes through something that's scary in the economic and the hiring cycle. You look at the millennials.
Yeah, I'll hand it to my millennials here. When June of 2010, they were facing an unemployment rate for 20 to 24-year-olds at 15%.
Yeah, so again, millennials went through the financial crisis. You go and take a look at Gen X, okay? Gen X was nervous that that every job and every all economic growth was going to end up in Japan, because that was the big fear then. You go and you take a look at the boomers, and when they were coming into the workforce 10, 15 years before,
82, they were entering labor force at an unemployment rate of similar to the Great Recession, 16%.
Again, I don't think any generation goes through this unscathed, but to call this a bleak job market, guys, I'm telling you,
it honestly does them a disservice, because it's just you're describing something as bleak that's actually can get a heck of a lot worse.
Okay, if you took a 22-year-old right now and took him back to June of 2010 and said, find a job, they would be crying to come back to 2026 by the end of the day.
Yeah.
I know, look.
The stories that were being written back then were of PhD graduates with what are today pretty useful. I'm not talking about the PhD in English Lit. No offense to the English Lit PhD. I'm talking about STEM PhDs delivering pizza in 2011.
Yes. I mean, it was bad. I mean, look, when I was graduating from college, I applied to 100 jobs. I got 3 interviews. Yeah. It wasn't even 3 offers. It was I got 3 interviews. It was brutal then. And this was back before everyone was screening with AI and this and that to weed you out. This was just no one wanted to hire because no one had anything to sell. It was brutal.
I think there's some good advice in some of these pieces, expect your first job is gonna kind of suck. You're going to do expletive work. That's kind of what the gig is, and if you end up delivering coffee around the office, and that's kind of what you do. Another piece of advice that I saw mentioned there is, I know everybody wants to go work for that giant name company and go back to their 5-year college reunion being known for the guy that worked for JP Morgan or for Johnson & Johnson or the massive big name that everybody recognizes. But, honestly, there are great opportunities at companies of all sizes. And I don't get me wrong, I started my career at a very giant, well-known company, and I value that time. But it's probably not the most important thing.
I don't care your examples of big companies were JP Morgan and Johnson & Johnson.
I was just stuck on J's.
Not Google or Meta or,
Stuck on J's, like I said.
It's fine. What else you got for me?
Layoff notices. Meta planning about 8,000 employees who I think were already terminated. And, the Zuck in there talking about how in the age of AI, success is not a given. No kidding, Zuckerberg. You guys are pretty far behind the 8 ball. I would say success is pretty far out of reach, not necessarily just not a given. Also, Intuit planning to cut their workforce by some 17% as the tax software maker is reckoning with their expected slowing growth going forward and just the software demolition that AI has taken to that market over the course of the last few months. I think these headlines, though, are what continue to spook not only recent college grads. The recent college grads are voicing it. I do see it there. But, speaking... I didn't actually speak to somebody, so, third-hand news from somebody working for Meta is, it's a pretty scary place to work right now. A lot of pressure. I have
heard anecdotally that morale is not good.
Yeah, there. So I can comprehend why the vibes are so weak right now in corporate America. But again, I think describing this labor market as atrocious and impossible to find work for recent college grads is doing them a disservice. Because unfortunately, it can get a hell of a lot worse than what we are experiencing right now, to the tune of twice as bad. So I will fully acknowledge if we get to a point where it's a rough labor market like we've seen at other times, it's just not right now.
You want an honest place where at least for the next 5 years there's a ton of demand and not nearly enough people?
I mean, nursing and construction.
Truck driving.
Truck? Okay.
There, between some changes from a regulatory perspective and other factors, you have not nearly enough drivers to cover the loads that are out there. And trucking rates have gone up by 75% in the last 3 months as a result of it.
How old do you have to be a long-haul trucker?
I don't know. Probably at least like 10.
16.
12.
I would think, I mean, like, you got to be 25 to rent a car. So at least 21 in the U.S. To do that. I'll tell you, could be a pretty fun gig as a 21-year-old to travel the country.
Do it for 3 to 5 years.
Like,
you know?
That'd be pretty, you have to be a pretty independent spirit and pretty confident at 22 to pick that up. But, man, that'd be pretty cool.
All kinds of opportunities right now. It is, again, who knows what the long-term picture looks like. But next 3 to 5 years, I think there are wide open opportunities in trucking. So there you go. Quick break here for the entire rest of the day, but we're going to be back at it tomorrow to finish up the week before.